Let's dive into our approach. The first and most crucial question to ask yourself is that what do you really know about the company? A company exists to offer services or products to customers that they are willing to pay for. This results in revenue for the company. Therefore, it's essential to understand what these services are, how they differentiate the company from its competitors, and how likely they are to remain in demand over the long term. Additionally, how good is the company at innovating and adapting to new developments in its industry? The management team also plays a significant role as they are the ones setting company's direction. Here are a few things you should typically learn about a business before you make a long-term investment. Let's take a pause. Why are we even doing this? Basically, we are interested in determining companies' ability to recover from a downturn. What will be management's approach to handle challenges? Downturns are not unusual for businesses, and even the best companies go through bearish phases. When this happens, will the company be able to recover or not? For instance, this chart shows share of revenue for Mac and iPad products as a percent of Apple's total revenue. As this has continued to slow down over last 10 years, Apple focused on developing its wearables and services businesses. While companies like Zoom, DocuSign, Fiverr, which all had huge bullish runs, could not sustain their capitalization. No doubt their products and services are still relevant. Perhaps their relevance was overestimated by the market. Now you know about the company. But do you know the stock? Knowing the stock is just as important as knowing the company. For starters, stock represents a portion of the ownership of the company. Let's go back to our example. This time, the company decides to issue stocks for 30% of its enterprise. Before the company can go to the investors, it needs the support from underwriters who will assist in establishing the right valuation of this 30%. Let's say they establish that they can split this 30% into 100 million shares, each valued at $10. This will mean that the company can raise $1 billion against a 30% share of ownership. This puts the valuation on the entire company at over $3.3 billion. The ongoing valuation of these shares is determined by how investors value the company's future. Now the company is responsible for sharing value with the investors. Every company follows a different approach. Take Apple, for example. Despite being a high-performing company, it doesn't offer significant dividends. Instead, it opts for share buybacks to maintain shareholder value and regularly splits its stocks to keep them affordable. Then there's Google, which has two types of shares, Type A and Type B, each with its own set of rights. This approach mirrors that of Berkshire Hathaway. Despite being highly successful, Berkshire Hathaway doesn't provide dividends. It believes in reinvesting earnings for growth. On the other hand, real estate investment trusts are structured to distribute most of their earnings as dividends. Some companies pride themselves on their dividend policies. Those that consistently provide growing dividends are often called dividend aristocrats or dividend kings. In summary, knowing the nuances of a stock, such as its dividend policy, share structure, and market behavior, can provide valuable insights for investors. Now let's move into what might be the most crucial aspect of our analysis. Understanding the company's financials, often referred to as the fundamentals. Every listed company is required to submit a 10Q for quarterly results and a 10K for annual results. These submissions are named after the SEC forms used for filing. There are three primary financial reports included in these submissions: the income statement, also known as the profit and loss statement or simply P&L, the cash flow statement, and the balance sheet. You can search online for 10Q and 10K submissions and review these documents. However, it's important to note that we are more interested in sustained results. Therefore, in order to get in-depth understanding of a company's performance, we need to analyze multi-period trends. I will recommend these two websites, which will greatly simplify this task by consolidating data from various sources across many years. They both have good user interface and ease of use. But there are still tens of indicators. Which ones should you look at? For beginners, I will recommend these indicators. If you are looking for dividend stocks, you can also add dividend yield and payout ratio. A resource like this can greatly simplify the effort required for such an analysis and allow you to do a multi-year or multi-quarter analysis in a quick few minutes. Imagine if you have to go through individual SEC filings or annual reports to all this information yourself. So, you have analyzed the financials. Another valuable dimension to consider is the current news surrounding the company. We can view these using stockanalysis.com as well. Otherwise, you can subscribe to a news channel or follow key people on X or YouTube. Headlines like company losing a crucial government contract or a CEO stepping down, or perhaps a company sharing concepts of new product, can profoundly influence the company's future prospects. While financials provide insight into past performance, news can offer valuable indicators of potential future developments. Now, we arrive at the pivotal question: does this stock belong in your portfolio? Think of it like assembling a soccer team. Each player has a distinct role to fulfill. While a defender may occasionally score, their primary objective is to thwart the opposition from scoring. Likewise, every stock in your portfolio should serve a specific purpose. Some may offer short-term gains, while others provide stable dividend returns for passive income. Therefore, it's crucial to analyze what you aim to achieve by investing in this particular stock. Understanding its role within your portfolio ensures alignment with your investment objectives and strategy. We've identified 5 key aspects without even touching upon the price or any technical indicators. This prompts an essential question: is this the right stock for us? Once you know the stock has a place in your strategy, then you can move to the phase of finding the right price. That concludes this video. Remember, in order to make informed investment decisions, seek necessary guidance from a professional financial advisor, as investing in the stock market carries inherent risks. If you found this video helpful, like this video and subscribe to the channel.